Welcome back. You're still tuned into Halftime Report. Let's talk about some market fundamentals and macros. A recent DSP mutual fund report says real growth of 6% is not fast enough for India to harness its demographic dividend. They add patchy growth is making bonds attractive. To talk more about this, we have with us Sahil Kapoor, market strategist and head of products at DSP Mutual Fund, joining us now. Sahil, good afternoon. Thank you so much for joining in. You have mentioned that bonds are more attractive because of the macros that we are seeing currently. Is this one asset class that one should be looking at right now? What happens to equities in this case? Because you also speak about how there is more capex which is going into consumption, but not so much into production or the capex industry, so to say, from the government. What do you make of some of these themes because of the change that we have seen?
The first thing you spoke about bonds. The 10-year GSEC has now rallied to about 6.65%. And when you look at the data right now, I think India has now about 5.4% in terms of real yield. I know this is slightly off because the last 6 months CPI is about 1.5% or so, very, very low, which makes the last 6 months real 10-year GSEC yield look, visibly very, very high. But even if you adjust for inflation, our core inflation is also running below 4%. So still the GSEC yield offers you around 2.5% or more in terms of real rates, which I think is very attractive. Second thing is that when you look at the growth, real growth is still putting in about 8% last quarter, although our long-term numbers are still aligned at about 6% or so. So if you look at any cut, 10-year, 20-year, 30-year, real growth is still 6.1 or 6%. In this cycle, what has suffered more is the nominal growth. And when you look at the drivers of all nominal growth numbers, for example, look at the BSE 500 corporate sales growth number. In this cycle, it's a measly 7.5%. So corporate sales are not very high. Stamp duty collections are also running at 10% or lower. Government revenue collections are 10% or lower. Even the projections, when you look at the budget, are for about 10% or so. So in totality, our nominal growth has shifted lower. In the 2000s, it was about 14%. In 2010, it shifted to about 12%. In 2020s, this number has shifted to about 10% or so, 14, 12, and 10. And in most recent numbers, we've seen it slip below even 9%. So my guess is that since growth is slowing down, which is also visible in the top line growth for corporate India, it will be very hard for companies to put in, let's say, a 20% profit growth. And if they can't put in that number, stocks trading at 25%, 25 times trailing earnings will not make a lot of sense. You need to have bargains for higher returns to fructify. And therefore, I think at this time, bonds make a lot of sense.
Okay. Sahil, the other macro which is possibly weighing down on equities is also what's taking place with the rupee depreciation. How have you factored that in terms of companies which would be, import focused or have higher debt on books in foreign currency?
Sure. See, in this cycle, I think one fortunate reality is that corporate India has a very strong balance sheet. When you look at, we divided the corporate India through sectors. And when you look at the whole, let's say, the heat map of the last, let's say, 3 decades or so, at this point in time, almost 90% of sectors are in the pink of health. We never had it better in terms of balance sheet. So we will not be too discouraged by the corporate India's financial health when it comes to, let's say, rupee depreciation. It does appear to be a more natural market readjustment for the rupee because our BOP is under some amount of stress. Visibly, when you look at the numbers, you look at the CAD, it does appear that we are doing very well, right? Our net exports have also been more or less flattish, but we haven't had any episode where we faced a problem of BOP. But when you look at the numbers more closely, you will find that 2 or 3 very large levers, which has helped India have a consistent balance of payment, particularly, let's say, the services exports. Services exports over the 25 years in FY1 to FY25 grew at 22%. But in the last 10 years, their growth rate has shifted to 9%. And when you look at IT companies, they are talking about 4-5% growth now. Remittances is also now growing in mid single digits. FDI, FI flows are anemic. So when you look at all these flows, one trend is clear: dollar inflows are struggling, and I think that is something which is weighing on the rupee.
Okay. Sahil, would you look at more, you mentioned IT right now. So IT, you would like IT from here on? And also, what's your thought on large cap versus mid cap names? Would you be preferring more large cap in this scenario right now?
Sure. So we've been, looking at IT for the last 3 to 4 months, and we mentioned it in our report also. Some of the large IT companies, the top 2 or 3, they does appear to have hit sort of fair valuation. They are under-owned in that sense. When you look at the share of IT companies in Nifty, it's at a decade low or even longer, at about 10% or so. They are also fairly priced, as I said, and they are also oversold. In that sense, if you look at, let's say, compare Indian IT versus the NASDAQ, currently on a 3-year rolling basis, we are underperforming by about 48%, which is the highest on record. I think highest was 49 or so. So this tells you that there is some merit in relative allocation to this sector. But one very important caveat that these companies have not become cheap. The valuations did not run down so much that they would have become an absolute pet. But yeah, on a relative basis, they do make sense. Secondly, on large cap, I think large caps do make a relatively better bet than mid and small cap, for the simple reason that mid and small cap stocks, which are trading at about 30-40 times multiple, but earning growth is less than 9%. ROEs are 14-15%. But when it comes to large caps, they are trading maybe at 20 times multiple, which is also high, but not as high as mid and small cap. But ROEs are much healthier at about 16-17%.
Okay.
So I think that is the preference here.
Take that point, Sahil. A lot more questions, but we are completely out of time today. But always a pleasure speaking with you. Thank you so much for joining us with your insights and the outlook on different asset classes in the market. Time for a break now. Up next, we'll get Mangalam Malu to focus on the FNO setup at noon. Stay tuned for that.
"26 years